RiverPitch is proudly supported by ACS and River City Labs.
Hello and welcome to RiverPitch, the show putting Australia's best startups to the test. I'm James Daggar-Nickson. Tonight, we focus on growth and how industry, investors and founders can work together to build an innovative ecosystem. And what better way to kick off than to talk to one of Australia's most famous investors, Steve Baxter. This former shark has been heavily involved in the startup community for the past few decades, investing in some of Australia's up-and-comers and helping to grow the nation's burgeoning tech industry. Steve Baxter, do appreciate you joining us this evening.
Thanks, James.
Lots and lots to talk about. But first, we were actually just talking before. I mean, you see a lot of people with an idea, a lot of people with a business plan coming into your offices. What do you look for? What are some of the characteristics that you're looking for in a founder, in a person, when it comes to them pitching to you?
Well, probably the first thing we look at is the person, or more specifically the team. If there's a core founding team, we care about them. So they've got to have the appropriate skills to pull off what they're talking about.
Yep.
And then they've got to basically be able to put up with 10 years of grind. The average time between start and successful exit is 8.7 years.
Right.
So my first business was 6, my second was 9. So it takes a long time. So do I want to sit across from the table from these people for the next, once a quarter, for the next 10 years and not want to choke the living daylights out of them or not want to talk to them? So it's hard. It's hard to sell. We've built up a lot of, I suppose, we can match a little bit now. We see quite a few hundred, up to 600 pitches a year or 600 investment deals a year. We don't talk to all those founders. We talk to a lot of them. And so we get to understand what we think makes up the type of team we want to invest in.
And so, what is that? I mean, is it alpha personalities, or is it somebody who has a track record of trying, perhaps even failing on a few occasions?
Well, track records help, to be honest. That's really helpful. If they've got a successful track record, they're going to get funded really easy, right? So that's not a problem at all. So what we would like to see there is okay, so it's the team, then it's the problem. They're also pretty linked, right? Then there's other sorts of things, the problems. And okay, what visibility, what special insight do your team have to that problem where we think that you'll be the ones that solve it? So the two are in some way interlinked, so we have to understand how well they can react to the problem. And then we look at the total addressable market of the problem and a whole bunch of other stuff. And then the idea is like, a good technical team with a good visibility of the problem isn't going to necessarily try a stupid thing to solve that problem.
Yeah.
So, and it might be the third or fourth thing that they actually try that actually gets some sort of resonance. So you can't get too tied up in their first crack at solving a problem.
How often do you get the finished product in terms of they've found a problem, they've got the solution with insider knowledge in terms of that solution, plus a business plan, understand the adjustable market? I mean, is that common, or is that something you kind of need to sort of tease out of them, help shape?
They always come down with a business plan, and so a lot of times with a minimum viable product, like an initial prototype. Essentially, like we for the most part won't see them unless they've got a prototype of some description. We have funded ideas. We've done it once, and we're trying to do it again. It's a scary place to go.
That's a leap of faith, isn't it?
It's a big leap. That's doing really well, actually. So
well done.
We're pretty happy with that one. So for men who may suffer prostate cancer in future, look up Maxwell Plus. It's a really cool business. So we really want traction. So actually what we fund ultimately is traction. The best sort of traction is profit. The next best traction is revenue. And after that's usage. So this company here, ClipChamp, 5 million users on platform. And they're customers, I'd love it if they were customers. Yeah. But 5 million users on platform, growing at 5,000 a day. That's traction. Now, I don't really care about the revenue model. We'll figure that bit out. But this is a growth curve like YouTube in the early days. So it's really important to jump on the back of that tiger and ride it for all it's worth.
At what point do you?
And in that one, there's a fantastic team. One of the guys who I ignored quite early, I should have funded early and I didn't, so I got in a bit later than I'd like. So because I was waiting for them to actually tick off some milestones, essentially. So it was still team, it was problem, and then they came to us with a pretty good idea. And as it turns out, they've just been granted a patent even. So it is really quite fantastic.
Well, you say you got it a little bit later than you would have liked to. I mean, you specialise in getting in pretty early when it comes to a lot of these businesses, these startups. What is that space like? I mean, how would you sort of describe the VC environment, if you like, here in Australia at the moment?
It's a lot better than it used to be. There's a lot more money in the space now. It's a lot more professional than it used to be. And that's no slight to anyone, because there's more competition. It has to be more professional. So it's actually that rising tides lifted all boats, I suppose. And there's very much more now a structured sort of early stage angel through to seed. So there's various. If I was to actually categorise them, you have they call it, I think very disingenuously, family, friends, and fools. But it's people who actually back people in the early days with some early seed capital. Then you have some seed funders, and I describe us more as an early stage seed funder. So actually a bigger sort of $200,000 to sort of $1 million check, to be honest. Then you have your bigger VC guys that typically come in $1 million plus. After that, once you build the prototype, early traction, product market fit. So everyone comes in at their various levels of the pipe to actually try and push this business along. Where
does the large institutional corporate money come in? Have you seen a big growth? I mean, Telstra have Telstra Ventures, IAG have their own thing. Pretty much all the banks do. I mean, you're starting to see a lot more mature, established businesses looking at this area as well.
What I'd say is I break venture capital firms down into two different sorts: straight financial VCs, people who are trying to get a return for their investors. And then what we call corporate VCs, those who are trying to actually leverage a VC investment in order to bring some form of innovation into their group. They're the scary ones. Really be careful of those. Well, I know lots of people out there in these firms, and I love yous all, but you can throw wet blankets over startups. They want to hug them too close. They want to constrain their growth by not selling to competitors, for example. So you have to be very wary when you take an investment of the motivations of the venture capitalists. Do they want to make a lot of money? That benefits you, for example, right? But then you get some firms that are halfway between, and some that are just straight corporate VC. You are going to fit inside. You're going to be a cog in our machine. We're going to fund you to be a cog in our machine, so they're a bit scary. Steve Baxter, we've got to leave it there. There's so much more we could have talked about. Loved it. Do appreciate it. Come back. It's all good. Absolutely. Look, we're going to take a quick break. When we come back, we've just spoken to a shark. Now time for the bait. We speak to a founder to get her perspective on venture capital. Stay with us. Welcome back to the program. Well, our next guest works closely with startups and entrepreneurs in their early stages and knows what it takes to make it big in Australia as well as abroad. RiverCity Labs CEO Peta Ellis joins us for, well, her basic pitching ideas. Peta, thanks very much for coming in. You, I imagine, come across a lot of startups, a lot of founders running RiverCity Labs. So are there any, and I spoke to Steve Baxter about this just before, are there any sort of common characteristics that you've sort of picked up on that a lot of successful founders seem to have or tend to have?
Absolutely. There are definitely some key common things that we see time and time again. Then there's always the ones that are a little bit different. But essentially the ones that push hardest win. And it's not just even the one, they have to obviously have a good business, a great team, lots of opportunity, working in an industry where they can actually grow a decent company from. But there are a lot of founders out there that take for granted that's, the startup ecosystem and the whole focus on startups is new and it's fun to be involved with, but they actually do need to back it up with some substance and have a good idea. They have to be hungry. They have to be, I don't want to use the word passion, but if you are passionate about an idea or a concept or doing something for a purpose, then absolutely you've got a lot to run with. The other thing is, if you've got some key expertise from a certain sector that perhaps you've come from, so say you've come out of finance, if you've come, if you've got marketing background, expertise from a previous role, if you've come out of a corporate organisation, you've got some industry knowledge where there's possibly some gaps, and you've got the skills to be able to take it forward in a new direction. But absolutely, the ones who are hungry, they have to work hard. I'm not saying the 24/7 hustle either. I mean, actually, don't leave any stone unturned. Reach out to the contacts, make the sales calls, talk to your customers. All of those skills are all human-related skills, and it's very difficult for a lot of people to do those, or it doesn't come naturally. Because it does seem like it's the idea of being an entrepreneur, the idea of being in that startup environment is becoming a more and more appealing career choice, if you like, for a lot of people. They hear about someone who, came up with an idea in their garage, and now, obviously, it's a unicorn and floats wherever that may be, the NASDAQ or here. And it all sounds so easy. That's right. Well, to that point,
is it hard? I mean, give us a sense of the reality of it and what some of the challenges actually are.
Well, look, we normally hear about them 10 years down the track.
Yeah.
And it looks amazing, and it is great, and we'd love to all have this amazing office with, you know, a dedicated team and great company culture, and, you know, it's not always like that. You've got 5 solid years of possibly doing it on your own with a co-founder, not with no money.
From your perspective, personally, as well as when you're speaking to people who are going through River City Labs, what are you telling them about how to approach possible or actual failure?
Look, it's real. So, and that's usually the reason why people don't start anything, is because if they don't start it, they can't ever end it. So, if you don't start, you can't fail. It's a huge issue of people even taking those first steps. So we in this sector talk about failure as it's real, it happens, we learn from it, what could you have done differently? We try to tell as many stories as we can, sharing the learnings of other founders on, you know, ways they could have done things differently. So it's not always looked at, you know, it's not always 100% failure, but there's definitely mistakes that you make. And also for founders where the businesses don't work out, or they didn't get capital in time, or there was a deal that wasn't structured right and the founder ended up, you know, having to shut down the business. There is so much learning within that individual. We'd love to see them recycle back into another company with those learnings. Like, there's so much value in that. Whether they don't go and found another company themselves doesn't really matter, but it'd be a shame to see all those learnings go back into a job.
Yeah.
So look, we encourage it. We talk about it often. We try and remove the stigma around it. But on the flip side of the stigma attached to failure, it's actually what the founder goes through emotionally with their family, how they communicate that. Because there's a lot of people on the journey that they take with them. So often it's not just the founder's issue; it's their family. It's what everyone went without during the time of sacrifice is huge. So it affects many people. And we need to have bigger conversations around this with more people outside of the Startup Network.
Peta, Ellis, it's been wonderful to talk. Thanks so much for your time.
Thank you for having me.
We've got to take another break. When we come back, we'll take a look at corporate and government investment in Australia's startups. Stay with us. Hi there, welcome back to the program. Silicon Valley, Tel Aviv, 2 of the major tech oases in the world. Of course, could Australia perhaps be on the next list? One of our cities make the list. Well, for that, we need corporates perhaps, as well as government, to help continuing encouraging innovation. For his tips on why this is important, we're joined by ACS's CEO, Andrew Johnson. Andrew, thanks so much for your time today. Look, it might seem like an obvious question, but we hear corporates talking about it, we hear governments talking about it, we're talking about it. Strong, viable, growing startup ecosystems. Why is it important?
Well, James, it creates a lot of value in a digital economy. So at the moment, you've seen disruption occurring right across the globe. Retail's been terribly disrupted. Media's been disrupted. So how do businesses create value in the future? And technology has removed a whole bunch of barriers to starting new companies. So your competition can come from anywhere in the world. And if we want to attract higher paying jobs in the future, then it's important that we have the rightly qualified and skilled people creating businesses for the future here in Australia. And
I want to talk about the corporate's role in that, but it seems it's the idea of innovation, startups and so forth, the digital economy. It's something that governments talk a lot about, and ours is no different. I remember when Malcolm Turnbull, the former Prime Minister, came to office, he spoke about the need to embrace innovation, and it was going to be a key pillar for future growth. What role should government be playing, do you think, in this space, and is it doing enough?
I think there's pockets where government's been doing a lot of great things. So if I look at New South Wales, you've just heard the recent announcement about a tech precinct down at Alexandria, 15-year time frame, so it's going to flow through over a long period of time. And it's really about doubling down on those key areas. So there's a real economic proof around precinct development. If you put talented people together, ideas generate, you can find ways to partner with others, collaborate with others, and expedite your growth.
So they're doing enough?
It's a good start.
What more? What else? What are some of the key things that you guys, what ACS think is important that we should be seeing from government?
So I think it is about how do we encourage more development in STEM type areas. We're big on maths in schools. The number of kids who are completing Year 12 maths has dropped off a lot in the last 10 years. Our overall scores in PISA in maths over 15 years compared to our OECD trading partners has been in big decline. And it's a competition. It's all about competitive advantage, and if you have higher talent, higher skills, you attract higher paying jobs. It's that simple.
What should our ambitions as a country, do you think, be? I mean, we talk about, maybe a Sydney, a Brisbane, Melbourne being on the list of some of these cities, as I mentioned before, Tel Aviv and so forth, San Francisco. Is that realistic? Is that what we should be aiming for?
I think it's all relative. So the size of the US market is 10 times larger than Australia. So I don't think it's realistic to say holistically that will be the world's largest economy. But if we look at our cities, there's a lot of congestion. There's a lot of upside possibilities around smart cities. If we can make it easier for our citizens to be mobile, to reduce congestion, to have more affordable housing within easy distance to the city, then we have the ability to double down and create new products and services that we can take to the world. So I think they're all really important things, and it's where do you start?
And do you get confidence from what you're seeing? I mean, you're living and breathing this. From what you're seeing as far as the startup environment in Australia is concerned, does it fill you with optimism?
It absolutely does. So there's a lot of talented kids at university doing engineering degrees, IT degrees, who can all roll out products since they've been in Year 10, Year 11, Year 12, who are fascinated by the creativity side of technology. Overall, the number of students completing IT degrees is still small. It's only 5,000 per year, a little bit less than that. And if we can double, triple those sorts of numbers, then the engine room will be there. So we don't quite have the volume of software engineers that can bring all these products and ideas to life at this stage, and that's something we definitely need to focus on.
Andrew, stay with us. When we come back, Steve and Peta will be back at the desk. We're going to have an all-star panel on fostering this startup scene here in Australia, so stay with us. Welcome back. Well, to get a better understanding of how founders, investors and corporates intersect when it comes to the startup scene, let's get to our all-star panel. Andrew Johnson, Peta, Ellis and Steve Baxter. There is a lot to talk about, a lot of interesting issues popping up during the various interviews. One of the big ones is the government, the role of the government and whether or not it's adequately playing a role. Steve Baxter, is it doing enough?
It could do a lot less. It could get out of our way and actually make things easier.
So not more?
So no, I think when you regulate, you actually inhibit innovation. Therefore, you actually stifle entrepreneurship. That's just a given fact. It's probably undisputable. So the less regulation, the better. However,
I don't see that happening.
No, we do like our regulation. So in one space in particular, they could have less regulation would be in the employee share option plans or employee share schemes. So the ability to pay your staff in the upside of the equity of the future of the company instead of in cash, which may come from investors or may come from sales. That's very important when it comes to capital efficiency of these companies. Staff want it. Right now, we have a better system than before 2015. In 2009, the Gillard-Rudd government changed it drastically. It was nuclear winter. It did change in 2015, so it's better. It can be a lot better, a lot easier, a lot simpler, and that would aid us a lot.
That's later, I suppose, in the profile of a lot of startups. But as you were saying, Andrew, there's a role, perhaps earlier, when looking at education, the idea of encouraging STEM, the idea of getting more people graduating university with degrees, STEM-related degrees.
And how do you incentivise that sort of system? So that's a tricky bit, but certainly from my perspective, if I saw kids finishing school at Year 10 and not doing maths in Year 11 and 12, I'd question are they going to get a full return from their investment? So even if it's just basic financial literacy, being able to make your calculations after you leave school, I think it's incredibly important to see that through to Year 12. And then those with high math scores often do really well in those technical subjects when they go into university. So I think it has changed in terms of brand in the last 5-6 years. There are a lot of people excited about what technology can create, and mums and dads are coming around more to, let's not go this safe option, being a law or accountant or a doctor. Still lose out to doctors, but we're getting there. And I think that pipeline will build, but only slowly and not quick enough in the next 5 to 6 years.
I think the important distinction there is the fact what technology brings, and the jobs that come from, or the businesses that found off of STEM graduates, for example, they can scale. So you can use a network or software to actually build a scalable business. Whereas if for every time you scale revenue, you have to add a doctor or a nurse, and there's nothing wrong with those jobs, bricklayer, whatever it might be, they're harder to scale. So much of the value in the world is coming out of scalable businesses. When you add $10 of revenue, you get 10 cents of expenses. That's what the big tech companies do. That's a lot different to a traditional business.
But isn't there a worry that the scale doesn't necessarily also equate to a scale in workforce associated with a lot of new technology companies, which goes to the this issue that has certainly risen to the fore over the past few years about the future of the workforce?
No, not at all. Look, the feedstock for tech startups is exceptionally bright, young, highly skilled people. You don't have to put bauxite or iron ore or coal on the front end, you put people on the front end. That's the reality. So their their expense bill is so dense with wages, which is an awesome thing. So we need more of them. To Andrew's point, we need to have more people coming through universities. That's what Peta does at River City Labs. We need more of them being made enthusiastic about entrepreneurship and enterprise as a way forward in life. And then we need to sort of get the government out of their way and let them just do it.
What are you seeing at River City Labs, Peta?
Well, basically on that point of education as well, it's not always about the government to introduce programs or, to push, STEM programs or through school or university, but it's supporting external players who are coming in providing education, exposure. So we run programs within schools and we're one of many. So the government doesn't always have to do it themselves, but definitely support those that are out there providing alternative education methods on different topics within education, because not all STEM either. There's that whole entrepreneurial mindset. There is multiple different ways to teach young people the business basics, and it's about government getting behind some of those smaller ones and enabling them to scale by providing access to their networks as well.
Because this is going to become more and more important, isn't it? To a point that we spoke about earlier. I mean, more and more people are seemingly seeing this as a real viable career option. They want to be not necessarily a founder, but involved in these sorts of businesses, these sorts of startup businesses. Yeah,
well, not everyone's going to be a founder or the entrepreneur. There are so many roles to play within a startup company or a tech company, and those skills aren't taught at school, what you're actually good at. So are you the marketing person? Are you the tech person? Are you going to be the sales person? There are so many different roles, but it comes down to your own personality skill sets, which we can definitely get better at teaching kids to identify with what they are and actually choose different roles, not so much direct career paths, because I think the average statistic is kids of the future are going to have 17 different careers with a combination of multiple skill sets. So gone are the days where you choose one career path with one set of skills. Obviously there are going to be some that are doctors, lawyers, more highly technical roles, but people are going to keep choosing and choose again, and they're going to have not one businesses, but 3 or 4, hopefully more, because we know it's going to take 3 or 4 failed attempts to actually get something that works. So we want to encourage the conversation about having a go, do lots of different things and see what you're good at.
A few issues around the funding scene as well, Steve. In particular, I want to get to the role of corporates in a moment, but the idea that there can grow a conflict between what the founder wants versus what the VC, the investor, wants, particularly as it relates to getting a return, or at least the view for the business.
That can be. So people who call themselves venture capitalists have a certain return profile they want to make for their investors. You've got to remember that typically the VC isn't the investor. They have other investors behind them, be it super funds or somebody else. They're trying to get a return for those investors. And they're trying to get typically an outsized return out of each one, because it's exceptionally risky and a lot of these things don't work. So going into that relationship, and we mentioned before that you should interview your VC and you should actually ask for reference checks and look into them a lot. Understand what they need to get in order to fulfill their investment return.
It's easy to say though, but I imagine for somebody,
Well, you ask them. It's a conversation. You're about to enter a 10-year relationship with this company. Sit there and say, okay, so what type of return are you promising your investors? I'll typically say between 25 and 35% IRR year on year, right? So from that, you can back calculate how much they've raised, how much they stick into each company, and it's a very simple spreadsheet to work out exactly what they've got to get. If your founder can't do that, then he's probably got to go back to primary school, to be quite blunt, right? Because that's pretty simple maths. You can do that and get an understanding, and you should do that, because it will help you in that conversation that you've actually researched this and you understand what they want. There's no surprises.
I think that a lot of the founders don't realise all their rights or what they can ask, because they're coming in often to ask for money. but they don't ask all the right questions in the early stages. And that's often where there's not a cultural fit there too with the companies, or understanding what the investor wants, what direction they want to take that company in as well. Does it align with the founder's vision?
And in the case where it's a corporate VC, where they can sort of say, okay, this is all really good, we have this relationship, by the way, you can't sell to any of our competitors, and these are the competitive fields. It can be debilitating. And I've actually seen corporate VC end with a low probability of outcome far more often than the opposite. So, you have to understand their motivations. Corporate VC's out to get some innovation learnings from this process, right? The financial guys are out to make money, and you should be aligned with that, because with money comes jobs, comes prosperity, comes success, essentially, right? So it's not a dirty word at all.
Unless, the corporate offers you access to a customer base that you otherwise wouldn't
they'll
get.
always say
access
that,
to markets that you wouldn't otherwise get.
They'll always say that. And think about the corporate. So why would the corporate sort of say, okay, so I've invested in you, and I think you've got a less than great product, so I'm going to invest in you. I'm still going to drag you into these markets in front of my customers to embarrass me. So if that product was good anyway, you can do that sale without their money on your equity table, right? That's actually possible, right? So, because if it's a good product, they're not going to sell it unless it's a good product anyway. So, that sale is still possible. This comes down to the grit of the founder at the same time.
I think it's asking the right questions and taking the time to ask those questions and delving, you've got to take your time, because, like Steve mentioned, there's so many deals that can cripple the founder if they don't find out that information in the beginning, or if stuff's promised, what does it actually look like? If they're promising access to customer bases or, sales channel, what does it actually look like? At what points are going to be handed over? How can you have access? You need those sort of details.
Because we need to dig in. We've actually done a couple of deals, and there's another one coming with a fantastic corporate VC. I'd love to tell you their name. They're a really big software company.
Clipchat? By chat?
No. The VC is a really big software company, and they whilst they may look like a corporate VC, they're not. They actually do that dance with the customers, and they are incentivised 100% to make money for the balance sheet of the parent company. That's the difference. So that they're not going to make dumb corporate errors, because those people over there controlling it are there to make money for this organisation, and that's important.
Andrew, what about when the startup becomes the establishment, when the startup becomes almost a corporate in itself, but a banner success, and Atlassian is probably one, and Afterpay more recently, Zip Money, these sorts of guys, how important are they in terms of inspiring and helping to grow the local ecosystem, even though admittedly Atlassian isn't listed in Australia, which is somewhat disappointing?
No, incredibly important. Success breeds success, and inspires others to follow the same suit. I think, to go back to your earlier question around VCs, I think when you look at the big boys, getting in early and having those discussions with venture capital early in the piece, so that you get to build relationships, people get to understand your vision, and not leaving it when you've only got a 2 or 3 month runway before you go looking for a door knock and perhaps coming across as desperate. If you can build those relationships early, have a real firm plan for how quickly you want to scale, what sort of equity you're willing to give up, you can absolutely expedite that growth.
Peter James, who I know you're very familiar with, a comment he made to me a while ago has stuck with me. He said the worst time from a startup's perspective to look and ask for money is when you need money. And he said that is the worst time to do it. It seemed like very sage advice.
He's got a lot of good ones.
He does.
Another one is one of his favourite ones is, where's the puck going? So big ice hockey, understanding what the market might need in 5 years' time. If you're building something for a gap in the marketplace today, pretty much guarantee that someone else has already focused on that. So where is industry heading? Where are the opportunities? And to start building that for now, for later.
We have to leave it there, unfortunately. Peter Ellis, Steve Baxter, Andrew Johnson, thanks so much for joining us today. Thank you very much. That is all for this week's River Pitch. I'm James Daggar-Nickson. Thanks for watching.
Vote now for your favourite RiverPitch entrepreneur. Go to yourmoney.com.au/RiverPitch/vote. Nominations close soon, so vote now.